Tesla's stock has been on a wild ride in 2025, down 38% from its peak, sparking one of the most heated debates on Wall Street right now. Some analysts still see massive upside, claiming Tesla is just going through a temporary downturn. But others are sounding the alarm, saying Tesla's best days may be behind it. And here's the thing, this debate isn't just about sales or competition anymore. There's something happening behind the scenes that could shake up Tesla's future in a way most people aren't prepared for. Later in this video, we'll break down one major development that could dramatically change how investors look at Tesla, and it's something even long-term bulls need to pay attention to. But first, let's break down why Wall Street is more divided on Tesla than ever before. At this point, Tesla has almost become a meme stock, but with actual fundamentals. That's why Wall Street's view on Tesla couldn't be more split. The bull case. Some analysts still believe Tesla is the undisputed leader in EVs and AI-driven automation, and even predict a massive rebound once market conditions stabilize. The bear case. Others argue that Tesla is past its peak with declining sales, shrinking margins, and Musk's political distractions driving the brand downward. So what are the numbers saying? Howard Lutnick, CEO of Cantor Fitzgerald, is still a believer. He's publicly stated that Tesla is too big to fail and remains one of the best long-term tech plays on the market. He argues that despite the turbulence, Tesla's dominance in AI, robotics, and energy solutions will propel it forward, making this current stock dip a huge buying opportunity. Lutnick has also doubled down on Tesla's AI ambitions, pointing out that Tesla is much more than just an EV company. It's an AI-driven technology powerhouse, and that's what makes it unique compared to traditional automakers. On the flip side, Minnesota Governor Tim Walz isn't just bearish, he's actively warning investors to dump Tesla stock. Walz has gone so far as to say Tesla is no longer an attractive investment, calling it a company that has lost direction under Musk's leadership. He pointed to growing regulatory pressure, a deteriorating brand reputation, and weaker than expected EV demand as key reasons Tesla stock may continue to slide. Some analysts at NASDAQ and Yahoo Finance still believe this is a rare buy-the-dip opportunity, citing Tesla's long-term AI and energy potential. However, they also acknowledge that short-term volatility could continue and that Tesla may need to make some serious strategic shifts to regain market confidence. Meanwhile, bearish analysts argue that Tesla's current valuation is still too high. Some firms have slashed their forecasts to as low as $85 per share, warning that Tesla's fundamentals don't justify its price, even after the recent crash. With such wildly different opinions from Wall Street, the question becomes, who's actually right? And that brings us to the real game changer. Something happening behind the scenes that could trigger a much bigger shift in Tesla's stock price than anything we've seen yet. We've talked about how Wall Street analysts are split on Tesla, but here's the thing. What analysts say doesn't always match what big money is actually doing. And right now, there's a major shift happening in institutional ownership of Tesla stock, one that could have serious consequences for investors. So who's buying? Who's selling? And what does it mean for Tesla's stock price? Let's break it down. Institutional investors, hedge funds, pension funds, and large asset managers hold significant influence over a stock's movement. When they start making big moves, retail investors should pay close attention. And here's what we're seeing with Tesla. A surge in selling from major Tesla stakeholders. Multiple funds that have been long-term Tesla investors are now reducing their exposure. Elon Musk's own brother, Kimball Musk, just sold a massive chunk of Tesla stock. Alongside him, key board members and Tesla's CFO have also been offloading shares. That's not exactly a confidence booster for investors trying to figure out whether to hold or sell. Institutional ownership of Tesla is starting to slip, with some funds choosing to reallocate capital into other AI-driven tech plays, like NVIDIA, which has been dominating the AI space while Tesla has been struggling. So, why are institutions pulling back? Weaker financials. Tesla's declining margins and revenue growth slowdown are raising red flags. Even bullish firms have had to revise their price targets lower in response to the company's financials softening. The brand's growing controversy. Some funds are reportedly stepping away from Tesla because of concerns about Musk's political influence and Tesla's increasing polarization. With protests, vandalism, and boycotts increasing, institutional investors may see Tesla as too risky compared to its past reputation as an unstoppable growth stock. Tesla's shrinking dominance in EVs. With BYD overtaking Tesla as the top EV seller in China and traditional automakers rolling out competitive EV models, some investors are questioning whether Tesla still deserves its premium valuation. Market rotation into safer tech stocks. With Nvidia and other AI-focused companies continuing to outperform, funds that were once heavily weighted in Tesla are now moving money into AI infrastructure plays. Now, that doesn't mean everyone is abandoning Tesla. Some funds are still holding, and a few have even increased their stakes. But overall, the trend among big investors leans negative right now. And when institutional sentiment shifts against a stock, it can put serious downward pressure on the price. So the real question is, could this selling get even worse? Well, there's one factor that could make things even more volatile for Tesla stock. And if it plays out the way some investors fear, this could be the most damaging development for Tesla yet. Tesla's stock isn't just being dragged down by market trends, it's now at the center of a global financial and political storm. One of the biggest risks Tesla investors are overlooking, the company's growing vulnerability to international economic shifts. Let's talk about what's really happening. Tesla's business in Canada is now at risk due to rising economic tensions. Canadian officials are considering new tariffs on Tesla vehicles, a direct response to U.S. policies under Trump. If these tariffs move forward, Tesla's ability to sell in Canada, one of its strongest international markets, could take a major hit. And that's not the only concern. Tesla's China troubles are far from over. China remains one of Tesla's most crucial markets, but competition is intensifying fast. The Chinese government is continuing to favor local EV makers like BYD and XPeng, which are rapidly growing in market share. Tesla has already had to cut prices multiple times in China to stay competitive. And if China escalates trade tensions, Tesla could face even more challenges selling in the region. But here's where things get worse. Tesla's ability to sell internationally has been one of the few things keeping its revenue numbers strong. If it starts facing restrictions in key markets like Canada and China, the company's growth prospects could take a serious hit. For investors, this raises a major concern. Can Tesla maintain its global dominance, or is it at risk of being squeezed out by local competitors? Will rising tariffs and political conflicts drive more institutions to move away from Tesla stock? And with Wall Street growing more bearish, will these external risks accelerate Tesla's stock decline? These questions are already influencing Tesla's stock movement, but there's another critical factor that could determine where the company heads next, and it's all tied to Elon Musk's net worth. For years, Elon Musk's wealth has been directly tied to Tesla. As the company's biggest shareholder, his stake in Tesla has long been his most valuable asset. But that's no longer the case. Following Tesla's brutal stock decline, Musk's ownership in Tesla is no longer his single biggest financial holding. Instead, his other ventures, like SpaceX, have overtaken Tesla in his portfolio. This isn't just about net worth rankings, it raises serious questions for Tesla investors. If Musk's wealth is now more reliant on SpaceX, does this mean he'll shift his focus away from Tesla? Could this weaken investor confidence, knowing that the CEO may not be as financially tied to Tesla's success as before? Does this explain his recent comments urging Tesla employees and investors not to sell their shares? Musk has always reassured investors that Tesla is his priority, but as his portfolio shifts, it's becoming clear that Tesla may not be the singular focus it once was. And with Tesla facing declining sales, political backlash, and increasing competition, investors have to ask, if Musk is looking beyond Tesla, should they be doing the same? What do you think? Is Tesla still Musk's top priority, or is he quietly shifting his focus? Let me know in the comments, and make sure to subscribe for more deep dives into Tesla's stock and future.